So joining me now to break down more of this market action is Simeon Hyman. He's a global investment strategist at ProShares. Simeon, it's great to have you. And what do you make of this market open?
Well, listen, we had kind of okay earnings from NVIDIA last night, and that calmed everybody down because, of course, going back to DeepSeek, folks were pretty darn concerned about where this AI trade was going. So I think that was a big comforting factor, and we should have a little bit less volatility today.
The president saying that tariffs on Mexico and Canada will start on March 4th. That's as soon as next week. Those 10% levies on China will go into effect as well. How does that impact the market?
It's interesting because the assumption should be that tariffs will be a little bit inflationary, and yet we've had a bond rally all across the curve, which is indicia that perhaps a little bit of a downtick in the economy could accompany the tariffs to keep inflation in bay, but perhaps at the cost of a little bit of GDP.
Interesting. So GDP for the fourth quarter, a second read this morning, coming in at 2.3%. Is that healthy by your measure?
It's not bad. We'll put it right with the NVIDIA earnings. It's okay. And again, it should keep for a relatively muted session today.
So with NVIDIA down about 12%, even with today's gains from its all-time high, and the market a few percentage points from its own record, how should people be looking at their risk portfolio right now?
Well, let's put the technology sector into a little bit of context. It's a concentrated thing. Tech is a little over 30% of the S&P 500. Here's some history. It was also about 30% at the end of 1999. So then you say, okay, I'm nervous. Now, here's some better context, perhaps. We were at 60 PE at the end of 99. We're at 35 now. Now, give me 10 seconds for accounting. Price to book at the end of 99 and today are about the same for the tech sector, and yet the PE's in half. That means those tech companies per dollar invested are making double the earnings. So that's where we call this kind of rational exuberance, but there's absolutely concentration risk.
So let's provide some numbers. I know that you watch these just in terms of how much the tech sector makes up of the overall S&P 500, and how does that compare historically?
Yeah, it's 30% today, and it was 30% at the end of 1999, right before the bubble burst. But here's another thing to think about. It's the individual company risk. Back to NVIDIA, if you looked at the close a couple of days ago, NVIDIA was down 6%, pulling the tech sector down 3%. Here's another name for you, IBM. IBM's almost up 20% this year, but it's had virtually no impact and nobody cares, because the cap weighting is such a concentration risk. And it's why we suggest to investors that even though the situation might not be the same as 1999, the opportunity perhaps to de-risk one's portfolio and perhaps even eliminate the tech sector. And we have at ProShares ticker SPXT, our S&P 500 X Technology ETF, which simply takes technology out of the S&P, might be a prudent way for folks to diminish some of that concentration risk.
Interesting. So in that particular ETF that takes out technology, what are the largest weightings in that would drive the path forward for that particular fund?
Yeah, I think about it in sector terms. So once you take out technology, you've now elevated the weight of financials, of consumer discretionary, and staples and industrials. And look, these are things that haven't had a bid in a couple of years, but the valuations are much more diminished, but the fundamentals of those other sectors have held up reasonably well. And that's why we think it may be prudent to diversify to the other 493 and perhaps lighten up on the technology sector.
I'm sure you'll be watching the inflation report tomorrow. You had referenced inflation earlier, of course, when we were talking about trade policy, and investors have been trying to digest what they've been learning about trade policy, of course, coming out of DC. What is your expectation for that PCE report on Friday that is the Fed's preferred inflation measure?
Yeah, it could be just a smidge elevated from expectations. The bond rally at the end of the curve has to be about some diminished growth expectations, because remember, Powell told us we weren't getting to 2%, we're getting to 2.5%. and that should imply more like a 4.5% 10-year. And I think we might see PCE a little bit inflated and perhaps see a little bit of that bond rally unwind coming into Friday.
All right, Simeon Hyman, he's a global investment strategist at ProShares. Simeon, thank you.
Thank you.
It's great to have you.